Good morning, everyone. Today I am here to take the topic What is risk? Let's see its definition. According to the International Organization for Standardization, ISO, risk is termed as an effect of uncertainty on objectives. An effect is a deviation from the expected. It can be positive, negative, or both, and can address, create, or result in opportunities and threats. Risk sources. Elements which alone or in combinations has the potential to give rise to risk are risk sources. Some of the risk sources are mentioned below. 1. Decision or indecision. 2. Business cycles or seasonality. 3. Market preference. These are few of the risk sources. Let's see them in details. Decision or indecision. Taking or not taking a decision at the right time is generally the first cause of risk. Let's see an example. Indecision in selling a government security when the market is upswing is also a risk as it causes loss of revenue. Second one, business cycles or seasonality. There are certain exposures that are affected by seasonality or business cycle. Example, lending to sugar industry in India, disregarding the fact that the production of the sugar is restricted to 6 or 7 months in a year, the lender is at a risk. The third one is market preference. Over the years, the consumer demands and preferences, particularly from the youth segment, are changing substantially. For example, the preference for a motorcycle over a scooter. Nowadays, the youth prefer motorcycle than a scooter due to the change. Then, risk is defined in financial terms as the chance that an outcome or investment's actual gain will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. Organizational risk is a potential for losses due to uncertainty. It is a term for risk at the top level of organization that includes strategic risk, reputational risk, regulatory risk, legal risk, security risk, operational risk, etc. Few examples of risk are unexpected financial loss due to an economic downturn or bankruptcy of other business that owe you money, loss of important suppliers or customers. Then other example is decrease in the market share because new competitors or products enter the market, so that you will face some risk. Few of the information were collected from the sources given below. They are ISO, your article library, Investopedia. Thank you for watching this video. I hope this section was understandable. Thank you.
Basic steps in risk analysis. Why do we do it? We do risk analysis to anticipate and reduce the effect of harmful results from adverse events, to evaluate whether potential risk of a project are balanced by its benefits, to aid in the decision process when evaluating whether to move forward with the project, plan responses for technology or equipment failure or loss from adverse events, both natural and human cost, to identify the impact of and prepare for changes in the enterprise environment, including the likelihood of new competitors entering the market or changes to government regulatory policy. Next, let us discuss the normal steps we take in risk analysis. The first step is identifying the risk. The first step is to identify the risk that the business is exposed to in its operating environment. There are many types of risk: legal, environmental, market, regulatory, etc. It is very important to identify as many risk elements as possible. Analyze the risk. Once a risk has been identified, it needs to be analyzed. The scope of the risk must be determined. It is also important to understand the link between risk and different factors within the organization. To determine the severity and seriousness of the risk, it is necessary to see how many business functions the risk affects. Thirdly, we have to evaluate or rank the risk. Risks need to be ranked and prioritized. Most risk management solutions have different categories of risk depending on the severity of the risk. Risk that may cause some inconvenience is rated lowly. Risks that can result in catastrophic loss are rated the highest. Treat the risk. Every risk needs to be eliminated or controlled as much as possible. This is done by connecting with the experts of the field to which the risk belongs. The next one is to monitor and review the risk. Not all risks can be eliminated. Some risks are always present. Market risk and environmental risk are just two examples of risk that always needs to be monitored. The main four basic steps in risk analysis. Risk. Risk analysis is the process of identifying and analyzing potential issues that could negatively impact key business initiatives or projects. This process is done in order to help organizations avoid or mitigate those risks. It allows you to examine the risks that you or your enterprise face and helps you decide whether or not to move forward with a decision. For example, there is a possibility of fire in an office building. Threat. In business analysis, threats are anything that could cause damage to your organization, venture, or product. This could include anything from other companies to supply shortages. Threats are negative and are external. This means that threats do not benefit your company, but there is nothing you can do to stop them from happening. As per the earlier example, in the fire there is a possibility of losing lives and property. Probability. What is probability analysis? Probability analysis is a technique used by risk managers for forecasting future events such as accidental and business losses. This process involves a review of historical loss data to calculate a probability distribution that can be used to predict future losses. The probability analyst view past losses as a range of outcomes of what might be expected for the future and assumes that the environment will remain fairly stable. There is no data attributing to the absence of a fire extinguisher in an office building. Hence, it would make better sense to get rid of fire extinguisher and save money and even space. So logically, there is very low probability of this threat ever materializing. The last one is impact. Impact analysis. A business impact analysis or BIA is a detailed look at the potential threats an organization faces. A BIA is an essential component of an organization's business continuance plan. One of the basic assumptions behind BIA is that every component of the organization is reliant upon the continued functioning of every other component, but that some are more crucial than others and require a greater allocation of funds in the wake of a disaster. Let's suppose that logically you have removed fire extinguishers from the office building and there is a fire incident which could have been prevented if the fire extinguishers would have been available. The high impact of people dying outweighs the mathematically logical move. In this case, because of the possible severity of the outcome, probability does not matter any longer.
Hello everyone. We are going to discuss about the topic how can be risk managed. First of all, we need to understand about what is risk management. Risk management is the process of identifying, evaluating, and prioritizing risks, followed by integrated and economical applications of resources to reduce, observe, and control the probability or impact of unforeseen events, or to maximize the realization of opportunities. How this can be managed? Risk management consists of 5 steps: risk identification, risk assessment, risk prioritization, risk mitigation, and last one, risk communication. We can identify risk by 6 ways: identify, analyze, control, transfer, then reduce, and assess. Now we can go through each one of them. First step is identify the risk. The first step is to identify the risk that the business is exposed to in its operating environment. There are many different types of risk: legal risk, environmental risk, market risk, regulatory risk, and much more. It is important to identify as many of these risk factors as possible. In a manual environment, these risks are noted down manually. Second step, analyze the risk. Once a risk has been identified, it is needed to be analyzed. The scope of risk management must be determined. It is also important to understand the link between the risk and the factors within the organization. To determine the seriousness of the risk, it is necessary to see how business functions the risk affects. How many business functions the risk affects. There are risks that can bring the whole business to a standstill if actualized, while there are risks that will only be minor inconvenience in the analysis. Step 3. Evaluate or rank the risk. Risks need to be ranked or prioritized. Most risk management solutions have different categories of risk, depending on the severity of the risk. A risk that can cause some convenience is rated lowly. Risks that can result in catastrophic loss are rated as highest. It is important to rank the risk because it allows the organization to gain a holistic view of the risk exposure of the whole organization. Fourth step, treat the risk. Every risk needs to be eliminated or contained as much as possible. This is done by connecting with the experts of the field to which the risk belongs. In a manual environment, this entails contacting each and every stakeholder and then setting a meeting so everyone can talk and discuss the issues. Last step, monitor and review the risk. Not all risk can be eliminated. Some risks are always present. Market risk and environmental risk are just two examples of the risk. This type of risk to be monitored. Under manual system, monitoring happens through diligent employees. These professionals must make sure that they keep a close eye on all the risk factors. Under digital environment, the risk management system monitors the entire risk framework of the organization. Thank you.
Types of risk. Types of risk include credit risk, organization risk, operational risk, information security risk, financial risk, market risk, system risk, strategic risk, franchise risk, insurance risk, legal risks, financial reporting risk, cross-border risk. Credit risk. Credit risk is a risk of loss due to a borrower not repaying the borrowed money. Credit risk is considered to be higher when the borrower does not have sufficient cash flows to pay the creditor. Example, a consumer fails to pay the amount due on credit purchases made. Organizational risk. Organization risks are which are associated with the organization and that can affect the activities of the company. Operational risk. Operational risk refers to the risk of losses that may result from disruptions to the day-to-day business operations. These risks can have a financial impact, affect the business continuity, even damage the organization reputation, and even weaken its market position. Example, a company failing to deliver the product on the time as promised to the customer. This can lead to the customer dissatisfaction and losing the potential friend from the customer. Information security risk. Information security risk includes cyber threats, risk of data loss, risk of losing customers' information, risk of losing valued documents or its informations. The companies can avoid the risk of data loss by adopting various cyber policies. Financial risk. Financial risk, as the term suggests, is a risk that involves financial loss to the firms. Financial risk generally arises due to instability and losses in the financial market caused by the movements in the stock prices, currencies, interest rates, and more. Market risk. Market risk is a risk of losses on financial investments caused by adverse price movements in the financial markets. Example of a market risk is changes in equity prices or commodity prices, interest rates moves, or foreign exchange rates fluctuations. System risk. System risk can be defined as a risk associated with the collapse or failure of a company, industry, financial institution, or an entire economy. It is a risk of the major failure of a financial system whereby a crisis occurs when a providers of capital, that is, depositors, investors, capital markets, lose trust in the users of capital. It is inherited in a market system and hence avoidable. Example, stock market crash in 2008. Strategic risk. Strategic risks are those risks arise from the fundamental decisions that the directors take concerning an organization's objectives. These risks essentially are risks of failing to achieve the business objectives set by the directors. Franchise risk. Franchising risk includes risk of reputation damage or losing trade secrets. Franchising risks have high startup cost and also high royalty. Example, if the franchisor do not meet products quality, then the franchisee can suffer heavy losses since they depend entirely on them for the goods. Insurance risk. Insurance risk is a threat that the insurance company has agreed to insure against. If the insured event is filed, then the insurance company has to pay the insurance amount to the policyholder. Example of insurance events like flood, agriculture loss, fire, theft, damage. Legal risk. Legal risk is a potential loss of the company that could face as a result of a legal issue. It could be a claim made against the company, or a change in law, or failure to take proper legal measures to protect themselves against the law. Financial reporting risk. A financial statement risk is inherent of both external and internal auditing activities. It refers to the possibility that auditors may fail to detect significant errors in an audit accounting report. It also includes errors in data entry and resulting in accounts not matching with others. Cross-border risk. Country cross-border risk is a risk that we will be unable to obtain payment from our customers or third parties on their contractual obligations as a result of certain actions taken by the foreign governments relating to the convertibility and transferability of a foreign currency.
Hello, today we will learn about risk treatment and its various options, that is, risk acceptance, risk avoidance, risk transfer, risk mitigation, and risk elimination. What is risk treatment? Risk treatment is a plan of implementing various strategies, activities, and actions to appropriately deal with the risk and manage it in a possibly profitable way. It is concerned with achieving desired outcome related to a risk or threat. Risk treatment is a part of risk management. It is not a concept on its own, but should be implemented as a part of risk management. 5 steps of risk treatment. So there are 5 steps of risk treatment that include brainstorming and selecting the right risk treatment option, planning and use of options chosen, examining the effectiveness of the chosen tactics, Deciding whether the level of the remaining risk, that is, the residual risk, is acceptable or not. If it's not acceptable, implementing new risk treatment activities to reduce the residual risk. Risk treatment options. Every organization has a different risk threat. There is no predefined one-fits-all method to tackle a risk. For example, electrical fires are dosed in a different manner compared to fire-related fuels. Even though both are types of fire accidents, both are treated differently. Risk can only be treated according to the situation. The risk can be effectively treated by opting for any one of the risk treatment options, which are risk acceptance, risk transfer, risk mitigation, risk avoidance, and risk elimination. Let's look at the first option of risk treatment, that is risk acceptance. This option simply instructs whether to accept the risk or not. If the risk identified is put through analysis and the risk rating is low, it is recommended for the organization to accept the risk since it is manageable and yields desired results. For example, a company proposes to construct its new office in a flood-prone area. It is very well known to the company that the area faces a lot of flooding during monsoon. However, the company approaches a construction company which has expertise in constructing buildings in flood-prone areas. This company ensures safety during the event of a flood and offers complimentary insurance package for the building. The former company is advised to proceed with its plan of constructing the building. So, by going with the plan of constructing the building, the company is actually accepting the risk. So, this is called risk acceptance. Risk avoidance. Risk avoidance is simply the opposite of risk acceptance. This option instructs to avoid the risk. After risk analysis, if the risk rating is high, it is advisable to avoid the risk. The company might choose another option instead, which has a much lower risk rating and is treatable. Risks are avoided in case of unprofitable returns after the risk is treated, or the risk simply puts the existence of the operations of the organization at stake. For example, McDonald's decided not to sell burgers made of beef in India since cows are considered to be sacred in India. They would have faced major backlash from fringe groups if they had sold beef burgers in India. The company went on with selling chicken burgers and vegetarian burgers. So this is a very well-known case of risk avoidance. Risk transfer. Risk transfer refers to transferring one portion of the threat that a business organization is facing to another organization. This transfer is done in order to reduce the impact of risk on its operations. However, it is imperative that the other party is informed of this transfer about its consequences and impact. Example, a company claiming insurance for damaged property as an aftermath of natural calamity. So, insurance is a very well-known form of risk transfer, and it is used by almost everyone among us. Risk mitigation. Risk mitigation refers to reducing the impact of risks or to reduce the likelihood of a risk to an acceptable level that the company is able to manage. The company might carefully choose some safeguards or controls in order to mitigate a risk. These procedures ensure that the company has some level of security after diminishing the risk. After choosing this option of risk treatment, it is recommended that the company analyze the residual risk, that is, the risk that is remaining in order to form a risk treatment plan for residual risk. Example, people use umbrellas during rain as a method to reduce the amount of rain that is falling on them. Holding an umbrella doesn't ensure complete safety from falling rain, but it is much better than being completely drenched during the rain. Having something for safety is much better than nothing at all. We all are familiar with this type of risk mitigation method. Risk elimination. Risk elimination is one of the most preferred risk treatment options. This option almost completely obliterates the incidence of a risk. This option, however, doesn't offer incentives as compared to the other options as no risk is faced by the organization. For example, rerouting cables in an office for protection from possible rodent attacks. So, let's conclude. Risks are inevitable to any organization, and each company is bound to face them at different stages of growth. That's why adequate risk treatment policies need to be implemented while planning the overall management plan. Every risk brings with it an opportunity to improve the business process. Organizations can use risks as a tool to grow and be more efficient. Thank you.
Understanding control. The next step after risk identification phase is preparing a risk treatment plan that will propose effective controls for managing the risk. For example, for mitigating risk of a computer virus attack, suitable antivirus software can be installed to safeguard the data. Risk management plan should always have a schedule for control implementation and persons responsible for the same. Meaning of control. Control is the function of management which helps to check errors in order to take corrective action. Control is done to minimize deviation from standards and ensure that the stated goals of an organization are achieved in desired manner. Controls are typically policies and procedures or technical safeguards that are implemented to prevent problems and protect the assets of an organization. Risks are present in every business. Regardless of why it transfers, control needs to be established to avoid or minimize loss to the organization. These are the two definitions of control quoted by Harold Kuhns and E.F.L. Brecht. According to Harold Kuhns, controlling is the measurement and correction of performance in order to make sure that the enterprise objectives and plan devised to attain them are accomplished. And according to E.F.L. Brecht, control is checking current performance against predetermined standards contained in the plans with a view to ensure adequate progress and satisfactory performance.
Let us discuss on the topic types of control. In an organization, internal controls can be divided into preventive control, detective control, corrective action, and preventive action. Detective control. A detective control is a type of control that seeks to uncover problems in a company's processes once they have occurred. Examples of detective controls: physical inventory checks, reviews of account reports and reconciliations, as well as the assessments of current controls as well as detective controls. In simple words, detective controls detect and control occurred undesirable events. The advantages and disadvantages of detective control. Advantages: they are less expensive and more reliable. They can be applied over a large number of transactions in a short time. The disadvantages: a continuous operating is involved which can be costly. These controls present evidence of an occurring loss but do not prevent a loss from occurring. Preventive controls. Preventive control attempt to deter or prevent undesirable events from occurring. They are proactive controls that help to prevent a loss. They are designed to be implemented prior to a threat event and reduce or avoid the potential impact of a successful threat event. Examples of preventive controls: separation of duties, proper authorization, adequate documentation, and physical control over assets. The advantages and disadvantages. The advantages: less equipment downtime, longer asset life, fewer interruptions to critical operations, increased workplace safety and improved compliance, improved efficiency, less risk factor, and money saving. The disadvantages are more upfront cost, more labor, potential for over-maintenance. The difference between detective versus preventive. Detective. It is an accounting term that refers to a type of internal control intended to find the problems within a company's processes. It may be employed in accordance with many different goals. Preventive. They are used to keep a loss or an error from occurring. These controls are typically integrated into a process so that they are applied on a continual basis. Corrective action. Corrective action is an improvement of series or improvements to an organization's business processes and procedures to correct the root cause of a non-conformance and to prevent their recurrence. It is a process of communicating with the employees to improve behavior or performance appraisal. For example, putting out a fire in the office is a correction. Accidents or security issues often require more tangible changes to the workplace, such as installing alarms, redesigning or replacing equipment, updating work processes, retraining employees on policies and procedures. The steps in corrective action are: define the problem, describe the problem, define the scope, containment actions, identify the root cause, plan a corrective action, and implement the corrective action. Preventive action. A preventive action is a change implemented to address a weakness in a management system that is not yet responsible for causing non-conforming product or service. Example, implementing new training programs for employees, regularly reviewing and updating company documents such as policies, procedures, code of ethics or code of conduct. Preventive actions versus corrective action. Corrective action. Locate and document the root cause of the non-conformity. Scan the entire system to ensure no other similar non-conformity could occur. Establish thorough follow-up to ensure the correction is effective and recurrence has been prevented. It's a reactive activity, happens the fact. Preventive action. Take proactive steps to ensure a potential non-conformity does not occur. Employ process and system analysis to determine how to build in safeguards and process changes to prevent non-conformance.